Welcome to UAN Payroll 101, Level 3. In Level 3, we will be discussing some complicated payroll concepts, such as employer pickup plans, the Family Medical Leave Act, healthcare reimbursements and the Affordable Care Act, unemployment compensation. We will talk in depth about OPERS and OP&FPF retirement. Look at required information in UAN that will make your life easier when it comes to monthly, quarterly, and annual reporting for payroll. And see how withholding amounts are calculated. Doesn't that sound like fun? Let's get started. Restrictions on wage expenditures. Here comes my best legal voice. Payments may be made for current payrolls from an appropriation account for that purpose, but only when the position and compensation of the employees have been determined prior to the current payroll pay period. Okay, wasn't a very good legal voice, and it was interesting legal words, but what does it mean? Fiscal officers cannot change what fund or appropriation account code an employee is paid from for the current payroll, unless the fund or appropriation account code that the fiscal officer wants to change the employee to was an approved appropriation code with money budgeted to it for the employee to be paid from prior to the current payroll's pay period. Employer pickup plans, Medicare and Social Security. Our first pickup plan is for Medicare or Social Security or both. A government can decide through adopted legislation to give its employees a fringe benefit of picking up or paying the employee share of Medicare or Social Security. The tax is calculated on the employee's gross wages plus the pickup amount, but the employee's share of the tax is paid by the government, not the employee. The employee's gross salary is increased by the pickup amount, and the take-home pay increases by the pickup amount less any increase in certain withholdings due to the increase in gross wages. So let's look at this. Here's employee Joe, no pickup plan. As you can see, his gross is $2,853.60. Zero for pickup plan. Ohio taxes are $112.90. Federal are $382.12. Medicare is $40.09. OPERS $285.36. Local $27.65. School $10.57. Other $738.81. So the total withholdings were $1,597.50, and Joe's net is $1,256.10. Now let's look at the same gross wages with a pickup plan. This is Medicare pickup. Again, Joe's gross is the same. The pickup amount is $40.68. Notice that is higher than what Medicare was on the last screen. Ohio, $114.53. That's also a little bit higher. Federal, $388.22. These are higher because that picked up amount, the $40.68, was added to the gross amount, $2,853.60. Now you can see that OPERS amount is the same, because OPERS is not calculated with the pickup amount added in, but local and school increased. So his total withholdings are now $1,606.43, and Joe's net is $1,287.85. This is an increased take-home amount of $31.75. Another employer pickup plan is for OPERS. Contributions to the OPERS retirement plans are made by the employer and employee. Under Section 414H2 of the Internal Revenue Code, an employer may pick up the employee's portion of retirement contribution to a qualified pension plan, such as OPERS. Taxes for the picked-up contributions may be deferred until the employee receives the contributions either as a refund after termination of employment or as retirement benefits. Without a pickup plan, employee contributions are generally taxable at the time the contribution is made. There are two types of pickup plans. Fringe benefit employer pickup. The employee contribution is paid by the employer as a fringe benefit. The employee's take-home amount increases because of the government picking up the employee's share of the OPERS contribution, while the taxable income remains the same for calculating federal, state, Medicare, local, and school tax. The cost to the entity is the amount of the picked-up employee's contribution share. Elected officials whose salaries are set by statute are generally not eligible to participate in a fringe benefit pickup plan because the amount picked up is treated as an additional compensation, which is not permitted under the statute. Now, village elected officials can have a fringe benefit program, but only at the beginning of a new term. The second type of pickup plan is salary reduction employer pickup. The employee contribution is paid by the entity, and the employee's gross salary is reduced by the amount of the contribution, thus reducing the amount of taxable income for calculating federal, state, and school tax. Under this plan, there is no cost to the entity since the amount picked up also reduces gross pay. Unlike the fringe benefit pickup plan, a salary reduction plan does not increase an employee's overall compensation. Therefore, elected officials whose salaries are set by statute may participate in a salary reduction pickup plan. Typically, the full amount of the employee's required retirement contribution is covered, but partial amounts may be picked up also. There are examples of these in the Payroll 101 document. Employer Pickup Plan OP&FPF. Contributions to the OP&FPF retirement plans are made by the employer and the employee. Under Section 414 of the Internal Revenue Code, just like OPERS, an employer may pick up the employee portion of the retirement contribution. Taxes for the picked up contributions may be deferred until they either receive a refund at termination of employment or as retirement benefits, just like OPERS. Without a pickup plan, employee contributions are generally taxable at the time that the contribution is made. There are two types of pickup plans for OP&FPF. They are the same as OPERS, the first being Fringe Benefit Employer Pickup Plan. And like OPERS, the contribution of the employee is paid by the entity as a fringe benefit. The employee's take-home amount increases because the employer is picking up the employee's share of the OP&FPF contribution, while the taxable income remains the same for calculating federal, state, Medicare, local, and school tax. The cost of the entity is the amount of the picked up employee contribution share, just like OPERS. And the second one is, again, salary reduction. The employee contribution is paid by the entity, and the employee's gross salary is reduced by the amount of the contribution, reducing the amount of taxable income for calculating federal, state, and school tax. Under this plan, there is no cost to the entity since the amount picked up also reduces gross pay. The Family Medical Leave Act. The Family Medical Leave Act is a federal leave act that provides a means for employees to balance their work and family responsibilities by taking unpaid leave for certain reasons. The law covers all public agencies. To be eligible for family medical leave, an individual must meet the following criteria: be employed by a covered employer, have worked at least 12 months for the employer, and have worked at least 1,250 hours during the 12 months immediately before the family medical leave. The Family Medical Leave Act entitles eligible employees to take job-protected unpaid leave for specified family and medical reasons. If an employee was receiving group health benefits through the entity when their leave began, the government must maintain them at the same level and at the same manner for the period of the family medical leave, as if the employee had continued to work. An employee may elect, or the employer may require, if board legislated, the employee to first use any unused paid leave for periods of the unpaid family medical leave. An employee who returns from family medical leave is entitled to be restored to the same or an equivalent job with equivalent pay and benefits. All government entities are required to display a poster explaining the provisions of the Act and telling employees how to file a complaint. The entity must provide a general notice on the Family Medical Leave Act to each new employee by including the notice in the employee handbook or other written guidance concerning its benefits and leave rights. Eligibility notice. When an employee requests family medical leave, the employer must notify the employee of the unpaid leave request and if it's considered eligible leave under the Act. And this must be done within 5 business days. If the leave requested is not eligible leave, the notice must state the reason why the leave is not eligible. Rights and responsibility notice. Each time an eligibility notice is provided for eligible leave, the employer is also required to provide the employee with a written notice detailing any specific expectations and obligations of the employee while off on leave, and explaining any consequences of the employee's failure to meet the obligations. If there's any requirement by the entity for the employee to make any premium payments to maintain health benefits, the arrangement for making such payments and the possible consequences of failure to make such payments must be included in the notice. Entities should consult legal counsel to be sure all needed rights and responsibilities are stated on the notice. The entity is required to make, keep, and preserve records pertaining to any request for family medical leave. This is in accordance with the record-keeping requirements of the Fair Labor Standards Act. The records must be kept for no less than 3 years and available for inspection upon request. Healthcare reimbursements and the Affordable Care Act. In 2014 and 15, this was a ticking bomb issue. Let's give a little background. Many Ohio governmental entities provide reimbursements to officers and employees for insurance premiums incurred by the officer or employee in securing health and hospitalization insurance coverage or Medicare Parts B and D premiums from a source other than the entity. This long-standing practice permits the government to facilitate the maintenance of insurance coverage while paying attention to the cost of the coverage to its taxpayers. With the enactment of the Affordable Care Act, federal authorities have issued conflicting statements which suggest that these reimbursements may constitute violations of the Act and may subject entities to penalty. Let's first discuss some relevant statutes from the Ohio Revised Code. Section 505.60 of the Ohio Revised Code empowers boards of trustees of Ohio townships to provide and pay all or any part of the cost of insurance policies for the benefit of officers and employees, and on and on and on. Section 505601 of the Ohio Revised Code applies to a township which does not provide an insurance policy or group health care services as provided in Section 505.60 of the Revised Code. In such instances, the township may reimburse any township officer or employee for each out-of-pocket premium for insurance benefits. Article 2, Section 20 of the Ohio Constitution prohibits any change in compensation which affects the compensation of any officer during his or her existing term. On March 21, 2010, the United States Congress passed the Patient Protection and Affordable Care Act, which was signed into law by President Obama on March 23, 2010. That enactment, together with the Health Care and Education Reconciliation Act, which was signed on March 30, 2010, constituted a significant regulatory overhaul of the United States healthcare system and its processes. After the passage and signing of the Affordable Care Act, the federal government issued several federal interpretations and directives pertaining to the Act. The United States Internal Revenue Service and the United States Department of Labor issued guidance and directives on the subject of employer reimbursement of health and hospitalization premiums. This initial material was widely interpreted to mean that, under the Affordable Care Act, it remained permissible for entities to reimburse employees for health and hospitalization insurance premiums for policies secured by the employee and not the entity, but that any reimbursement amounts would be subject to personal tax liability, and that no such reimbursement could be made with pre-tax or untaxed dollars. However, on November 6, 2014, the Department of Labor, Employee Benefits Security Administration, issued a document entitled FAQs about Affordable Care Act implementation, and that document contained the following question. My employer offers employees cash to reimburse the purchase of individual health insurance policy. Does this arrangement comply with the Affordable Care health insurance market reforms? In response to that question, the Department of Labor said, no. If the employer uses an arrangement that provides cash reimbursement for the purchase of an individual market policy, the employer's payment is considered part of a plan that is maintained for the purpose of providing medical care to employees. Therefore, the arrangement is group health plan coverage and is subject to the market reform provisions of the Affordable Care Act applicable to group health plans. Under Section 146.145 of the Code of Federal Regulations, a group health plan is defined as an employee welfare benefit plan to the extent that the plan provides medical care to the employees or their dependents directly or through insurance reimbursement. Recently, the United States Internal Revenue Service issued a document that indicated that employer reimbursement plans are group health plans that will fail to comply with market reforms that apply to group health plans under the Affordable Care Act. That was a lot of information. So, what's the current status on this here in Ohio? The Auditor of State says that after issuing conflicting positions, federal authorities have concluded that any Ohio entity which engages in the insurance reimbursement practices allowed under Ohio law render the practice a group health plan for the purpose of the Affordable Care Act. It is their contention that any such plan is in violation of certain standards imposed upon group plans by the Act, and therefore, any entity which continues to provide reimbursement is subject to financial penalty. The auditor said, obviously, this is a matter of great concern to Ohio governments, and any change of the entity's reimbursement practices or provision of insurance coverage must be examined in the light of the Ohio constitutional provision prohibiting any interim increases or decreases in the compensation of township elected officials. And on June 30th, 2015, the Ohio Attorney General's Office provided Opinion 2015-021 on the practice of healthcare reimbursement by Ohio governments and the Affordable Care Act. The Attorney General's Office said all Ohio entities who in the past have reimbursed officials or employees for health care premiums should ask the government's solicitor to review the auditor state's opinion for guidance on any possibility of reinstating any health care reimbursement program allowed under Ohio law. So in other words, you should probably talk to your solicitor. Unemployment compensation. The Ohio Department of Job and Family Services assist employers in meeting their labor needs, help job seekers, aids unemployed workers by maintaining benefit payment programs, support benefit payments by collecting employer contribution payments, and administer job placement and job training programs. The Ohio Unemployment Compensation Trust Fund is funded from the payroll taxes paid by Ohio employers and is used to pay benefits to unemployed workers. All governmental entities are reimbursing employers that only need to pay if an employee is granted unemployment benefits. Reimbursing employers are billed monthly. The billing will indicate the total amount charged to the entity during the previous period. These billings must be paid by the last day of the month in which the statement was received. The Ohio Department of Job and Family Services collects wage data for all employees on a quarterly basis for the primary purpose of determining claimants' eligibility for unemployment compensation benefits when an application for benefits is filed. So who do they consider as an employer? The Ohio Unemployment Compensation Law describes an employer as any individual or type of organization, including any partnership, limited liability company, association, trust, estate, or corporation. The law also includes the state and its political subdivisions as employers. So what is covered employment? An entity is liable under the Unemployment Compensation Law if wages are paid to persons in covered employment. The law provides that covered employment includes an individual's entire service performed for the state of Ohio in any of its political subdivisions. And it also defines employment as services performed for wages under any contract of hire, written or oral, express or implied. Is there any excluded employment? Yep. Any publicly elected or appointed official of the state and all of its political subdivisions are excluded from unemployment compensation coverage. So when is an employee eligible for unemployment compensation? An individual becomes eligible to collect unemployment compensation when the present unemployment is involuntary or not the fault of the unemployed employee, and the individual is able to work, available for work, and actively seeking work, but unable to obtain suitable work. So what's entity responsibility? Well, after an unemployed individual applies for unemployment compensation, the entity will receive a request for separation information. The entity must return the completed request within 10 working days after the date the form is mailed to the entity. If the entity does not return the form by the due date, the Ohio Department of Job and Family Services will determine the claimant's eligibility for benefits on the basis of any available information. The entity should describe in detail the circumstances surrounding the separation of the employee from the entity. There are times when an employee who was terminated for good and documented reasons will try to apply for unemployment compensation that they are not due because they were terminated, not laid off, or let go because of lack of work. Withholdings. Back we go to withholdings. Here we are going to discuss in depth OPERS and OP&FPF, Ohio Public Employees Retirement System, or OPERS. OPERS was established in 1935 to make available a secure means of providing retirement for Ohio public employees. OPERS is older than Social Security. In general, OPERS membership is required for all public employees, regardless of hours worked or salary earned. Employers must withhold and remit the employee and employer contribution on behalf of the employee beginning with the first day of employment. Although membership is required, the process by which an individual becomes a member requires the entity to take action. Specifically, employers are required to have the employee complete and then the entity submit to OPERS a personal history record and Form SSA 1945, which is the Statement Concerning Employment in a Job Not Covered by Social Security. The personal history record must be submitted within 30 days of the individual's first day of employment. The definition of a public employee is any person holding an office not elective under the state or any county, township, municipal corporation, park district, conservancy district, sanitary district, health district, metropolitan housing authority, state retirement board, Ohio Historical Society, public library, county law library, union cemetery, joint hospital, state university, or board, bureau, commission, council, committee, authority, or administrative body. It's a lot, isn't it? Effective January 7, 2013, independent contractors or any other individuals not considered to be public employees must complete the independent contractor worker agreement form not later than 30 days after the individual begins providing services to a public employer. Employers must retain this form and send a copy to OPERS. It's crucial for employers to establish the appropriate relationship when entering into contracts because the relationship in the contract determines membership. If there's a period during which contributions are not withheld and sent to OPERS, and membership later is determined to be required, the employer is liable for both employee and employer contribution. If OPERS receives contributions for a person who is ineligible for membership, the employee contributions will be refunded. This becomes a real headache because OPERS only refunds the employee portion. The employer portion of the refund must be applied as a credit to future OPERS withholding payments. So, if you're uncertain if someone should be considered an employee or an independent contractor for OPERS membership, contact OPERS to request a status determination. There are some specific position membership rules, such as elected officials. Elected officials may choose at the beginning of their first term whether they would like to contribute to OPERS or Social Security. All elected officials, no matter how small their earnings, must contribute to one of those. By definition, an elected official is an individual who is elected by the public or appointed to fill an elective position. For elected officials who choose membership in OPERS, the entity must send OPERS a personal history record. If an elected official wants to become a member at any time during their elected term, they may do so, as long as they have not previously been a member at any time during their elective service. But once OPERS membership is chosen by an elected official, any elective position after the original OPERS member date must also have OPERS contributions deducted. Law Enforcement Division employees. Retirement coverage is available for certain law enforcement officers. These employees are referred to as OPERS Law. To be considered eligible to become a member, the employee must be identified by the entity as full-time and their specified primary duties as preserving the peace, protecting life and property, and enforcing the laws within their jurisdiction. They must also have a police officer's training school certificate and be hired after the date of the state legislation pertaining to the specific type of law enforcement officer they are. See the Payroll 101 document for these dates. Firefighters and EMT. Eligibility requirements for firefighters and EMT positions can be very confusing. If the entity is unsure about eligibility in OPERS, the fiscal officer should call the OPERS Employer Outreach Division for more clarity. Full-time firefighters and EMTs hired after August 3, 1992, and trained in a state-approved fire or EMT training program are exempt from contributing to OPERS and must contribute to Ohio Police and Fire Pension Fund. Part-time and even paid volunteer EMTs should contribute to Social Security, but part-time paramedics contribute to OPERS. Public Safety Directors. With the passage of Senate Bill 267, effective March 24, 2009, public safety directors must contribute to OPERS at the local contribution rate, or OPERS-R. Public safety directors had paid into OPERS at the public safety law enforcement rate. Regular reemployed retirees. Employees who have retired from public employers covered by OPERS or any of the Ohio retirement systems are called reemployed retirees. Membership for reemployed retirees is mandatory. Specific rules must be followed for employers who are considering reemploying retirees. It's critical that you as the employer realize that reemployment in a job covered by OPERS may affect the retiree's ability to continue to receive OPERS retirement benefits. Employers should not reemploy a retiree for at least 2 months after retirement to ensure that there is no negative impact on benefits. This rule applies even if the retiree waives all pay for the 2-month period. So what are employer responsibilities? The entity must determine whether a new hire is a retiree from any of the retirement systems, and if they are, the entity must notify OPERS to ensure that it will not be held responsible for any overpayment of benefits. OPERS retirees who are rehired must complete and submit either the Notice of Reemployment of an OPERS retiree or Notice of Reemployment of an elected official. No new hire personal history record is required. The entity is required to certify and submit the form to OPERS by the end of the first month of employment. Termination of OPERS membership. When an employee leaves public employment, he or she has decisions to make. The employees may choose to leave their contributions on deposit with OPERS, take a lump sum refund, or roll it over to another qualified retirement account. Employees should be encouraged to contact OPERS directly so they can choose the best option for their circumstances. If an employee chooses to terminate membership in OPERS by requesting a refund, the entity will be required to certify the date the employee terminated public employment. OPERS contributions and reporting. Employers have very specific responsibilities required by law. Public employers are required to withhold and remit employee contributions for all OPERS members and those who have chosen to be members. Contribute a specific amount for each OPERS covered employee. This is the employer contribution. And generate and send accurate reports and payments to OPERS on the time worked and contributions withheld for each employee. Accurate reporting of employee contributions is critical for OPERS covered employees because the information ensures the correct service credit is applied to each employee's retirement account. We will discuss in detail payment and reporting for OPERS later in Level 4. What is considered earnable salary by OPERS? By law, contribution calculations are only made on the earnable salary paid to a public employee. Some examples of earnable salary are salary and wages, payments for used leave, one-time lump sum or periodic bonus payments that are based on the employee's basic rate of pay. For example, a bonus of 40 hours at their basic pay rate. Overtime or comp time worked if paid in the year earned. Longevity payments. Payments made for assuming call or standby responsibility. Award of back wages to employees or retirees who've been reinstated to their position based on arbitration award, personnel board of review, or court order. Payments made for the payout of certain accrued and not used leave, but only if paid during the year that the leaves were accrued. And what about non-earnable salary? These are earnings that are not used in calculating retirement contributions. Some examples are fees paid as sole compensation for services. An example would be a zoning inspector whose only pay are the fees for inspection and fees for permits. Amounts paid by the employer to provide health insurance benefits, premium payments, and payments made to a health savings account. Reimbursement for job-related expenses. Overtime or comp time work pay if not paid in the year earned. One-time lump sum or periodic bonus payments that are not based on the employee's basic rate of pay. For example, they give a $500 bonus to all public employees of the entity. Payments made for payout of certain unused leave, but only if paid after the year the leaves were accrued. So, paid in January of the next year. Any amounts in excess of gross salary paid under a fringe benefit method as picked up contributions. Remember, we saw that in our earlier pickup plan example. Payments made on a per something basis, such as per meeting or per fire run. And payments made at termination for overtime, accrued vacation leave, sick or personal leave, which is considered termination compensation. If you're not quite sure whether some form of compensation should be considered earnable salary, you should request a determination from OPERS. It's best to ask for a determination prior to reporting the contributions. In addition to the actual contributions, employers are responsible for reporting specific information. At OPERS, your employees' contributions are posted to each individual's OPERS account with the information from the report of retirement contributions that you submit. Service credit is the term used for the period of employment an employee has had with a public employer and receiving earnable salary. It's crucial for employee service credit information to be accurate because it ultimately determines eligibility for retirement benefits in healthcare. Each year, a full-time contributing service with a public employer earns an employee 1 year of service credit. Full-time service credit is earned by employees who contribute at least the minimum salary each month. Earnings are posted according to the end date of the employee's pay period. Part-time service credit is earned by those who receive less than the minimum earnable salary per month. Those employees receive prorated service credit. Delinquent contributions. It's your responsibility as a public employer to withhold, report, and send employee and employer contributions. If a situation arises that an employee has not had employment reported to OPERS, it was overlooked, you weren't sure, immediate action, though, should be taken to report the employee's service credit and contribution to OPERS. Yearly non-contributing report. All public employers are required to submit annually a complete list of all non-contributing employees and any individuals who, in the prior year, provided services to the employer and were classified as an independent contractor. We will go into more detail on this annual report in Level 5. Ohio Police and Fire Pension Fund. Ohio Police and Fire Pension Fund is one of 5 Ohio public retirement systems and provide pension, disability, survivor, and health care benefits to eligible full-time police officers and firefighters and their beneficiaries. The Ohio General Assembly created OP&FPF in 1965. replacing 454 separate local police and fire pension funds in Ohio. A percentage of each member's salary is submitted to OP&FPF as member contributions. In addition, the employer contributes a percentage of each member's salary. When an employer submits a payroll report, the report of retirement deductions, and contributions to OP&FPF, the payroll report as well as the member contributions are reviewed for compliancy. Once the report and accompanying payment are determined to be compliant, OP&FPF will post the contributions to the member accounts. These accounts serve as basis for the computation of retirement, disability, and survivor benefits. So they're very important. So who are OP&FPF members? OP&FPF members are full-time firefighters and police officers. OP&FPF cannot accept contributions for part-time employees, volunteers, temporary employees, and other safety officers that may or may not be covered by OPERS or Social Security. When a new OP&FPF member is hired, the employer must remit the following completed forms to OP&FPF. First, a completed and notarized personal history record with key personal information, such as name, address, Social Security number. This must be submitted at the time of hire. Number 2, according to Ohio law, prospective OP&FPF members must undergo a comprehensive pre-employment physical prior to becoming a member. The pre-employment physical form and examinations are to be completed prior to the date of hire. These tests and the corresponding forms are due to OP&FPF within 60 days of the member's date of hire. If the pre-employment physical form is late, a fine will be imposed on the entity from the date the report was due until the documentation is filed with OP&FPF. Make sure you pay attention to this, because I've seen some entities that have had some very large fines because of this. Third, a copy of the completed statement concerning your employment in a job not covered by Social Security. That's Form SSA 1945 that we talked about in Level 2. And the employer must submit documentation such as an appointment letter or meeting minutes that verifies the member's full-time appointment date. For firefighters, the employer must also provide a copy of the firefighter training certificate earned upon completion of such training. A copy of their certification card will also suffice. If an employer has questions about whether a position is eligible for membership, call OP&FPF for a determination of membership. Re-employed retirees. Employees who have retired from public employers covered by OP&FPF or any of the Ohio retirement systems are called re-employed retirees. They must contribute to OP&FPF. The same specific OPERS rules for rehiring retirees apply to OP&FPF. So what's the employer responsibility? The entity must determine whether a new hire is a retiree from OP&FPF or any of the other retirement systems. And if they are, the entity must notify OP&FPF to be sure that they will not be held responsible for any overpayment of benefits. Termination pay. When a member terminates employment, they are usually entitled to receive several types of termination pay that they accrued during their active career. This termination pay is generally non-pensionable. However, if termination pay includes holidays or longevity that was earned within the last year, these items are pensionable and need to be included on the final payroll. Please contact OP&FPF if you have a member terminating employment and you have questions about processing their final payment. OP&FPF contributions and reporting. Member and employer contribution rates are set by Ohio law. Employers need to know when any changes have been made to employee or employer contribution rates through legislative action. Employers are held liable for any contributions calculated and submitted to OP&FPF at a wrong contribution rate. The member and employer contributions are due to OP&FPF monthly. These contributions, along with the report of retirement deductions, are due on the last day of the month following the month the wages are paid to the member. For example, The member's earning period ends on Friday, August 27th. The payroll report and related contributions are due on or before the last day of September. Employers must submit police members and fire members on 2 separate report of retirement deduction reports. Because there are some employers with similar names, each employer has been assigned a unique employer code by OP&FPF, which specifically identifies the employer and determines if the members are police officers or firefighters. The employer code must be displayed on all correspondence and reports sent to OP&FPF. So what is earnable salary? Not all wages earned by a police officer or firefighter are considered salary under the laws and rules that govern OP&FPF. But some examples of earnable salary are salary and wages, paid leave. Overtime is pensionable as long as it's paid within the pay period earned or the following pay period and reported to OP&FPF within 60 days of when the overtime is worked. If a member chooses to bank overtime or comp it, worked overtime, or comp it as we call it, for use at a later date, the time is not pensionable until it is used to make up the member's regular schedule at a later date. This is then comp time used and paid and is pensionable at that time. Retroactive payments are considered pensionable regardless of when they are earned. Payments such as longevity, shift differential, acting pay, stress or hazard pay, educational allowances, performance bonuses, and sick leave incentives that do not reduce the member's sick bank are considered pensionable salary if paid within 1 year of when earned. Grievance settlements resulting in the reinstatement of a member may or may not be considered pensionable. Depends on the language of the settlement. The entity should contact an OP&F employer service group specialist prior to submitting contributions on such settlements. So if there is a question regarding the pensionability of wages, it is recommended that the employer contact OP&FPF for guidance. So what's considered non-earnable salary? Pensionable salary does not include, but is not limited to, reimbursement of expenses, overlapping pay that occurs when a member works a vacation day. Do not pension or report both the vacation day and call-in time. The call-in time makes up the base hours and base wages and becomes the pensionable portion. The vacation would be considered a cash out and is not pensionable. Holiday and other payments deferred for more than 1 year. Early retirement incentive plans. Signing bonuses or payments made for ratifying a collective bargaining agreement. Sick leave bonuses or incentives that reduce the member's sick leave bank. And terminal pay, which includes the following lump sum payments for accrued but unused sick leave, vacation, personal leave, and comp time. We will discuss completing and submitting the contributions report in more detail in Level 4. Other important withholding information. Don't allow the employee to dictate their withholdings. For example, an employee receives a bonus check from the entity and asks the fiscal officer not to deduct the garnishment deduction from the check because it's deducted from their regular pay. An employee cannot dictate from what earnings the garnishment should or should not be deducted. The fiscal officer in this case should review the court documents or call the garnishment agency to check whether it should be deducted from the bonus pay. Call the child support, garnishment, or retirement agency if you are unsure whether the withholding should be deducted from an employee's wages. And third, always, always, always document employee requests for changes in withholdings. For example, an employee that has Internal Order of Police, or FOP, dues withheld from their wages requests that the fiscal officer withhold a lower amount or not withhold it at all on the next pay. They are short of money this week. The fiscal officer knows that the entity receives a notice from FOP with the withholding amount that the employee has authorized. If the fiscal officer would lower the amount withheld or not withhold any amount for FOP, the fiscal officer could be held liable for that withholding that should have been deducted from the employee if no written prior authorization for the change was acquired from the employee. So, know each employee's withholdings and the rules that apply to making changes to the withholding. UAN Add Employee Wizard. What could this be? The wizard is used to enter new employees and elected officials into the UAN payroll software. This was built into the software to provide step-by-step instructions for adding an employee to payroll. Though the Add Employee Wizard is very user-friendly, the fiscal officer will need to have all of the information required to add an employee to UAN payroll gathered together before beginning the wizard process. We will discuss next what information you need to add an employee and why some of the information is needed. It is very important to add an employee correctly with all of the information needed to not only process wages for the employee, but also to ensure accurate reporting of wages and withholdings for not only internal reporting purposes, but also required external reporting and payment of things like taxes and retirement. So what are some of the things you will need before starting to add an employee in Wizard? First, you'll want the federal Form W-4. From this form, you can get the employee's name, address, Social Security number, number of federal tax exemptions, and whether the employee is taxed at the married rate or single rate. Ohio Form IT-4. From this form, you can get the employee's number of Ohio tax exemptions and the employee's public school district of residence to check if the school district has an income tax and what the rate is, and also any local municipal tax. EFT authorization form and a canceled check. If the entity provides direct deposit of wages for its employees, then you will need a signed authorization form and a canceled check to enter the required information. Withholding elections and paperwork. This would be other than federal and Ohio income tax, such as Medicare. Is the Medicare deduction regular or fringe benefit? Supplemental federal. Does the employee want an additional federal tax amount withheld from wages? This amount, if any, is found on the federal Form W-4. Supplemental state. Does the employee want an additional state tax amount withheld from wages? This amount, if any, is found on the Ohio Form IT-4. Retirement. Is the employee an OPERS, OP&FPF, or Social Security contributor? If Social Security, is the deduction regular or fringe benefit? Same goes for OPERS and OP&FPF. They could also be salary reduction, child support if needed, garnishment if needed, insurance elections. Which ones offered by the entity did the employee choose? Medical? And if so, is there an employee withholding amount? Dental, vision, life insurance, AFLAC insurances, deferred compensation, union dues, earnings information and legislation. You will need to know what earnings to add for the employee, such as salary, hourly, per item. You'll need the position name, what department the employee should be included in for wage purposes, the earning rate, their pay frequency, is it biweekly or monthly, which withholdings to attach to each earning, because not all withholdings are deducted from every earning, and to which appropriation account codes should earnings be charged. Overtime eligibility. Which employees are considered overtime eligible? Does the entity have more than one overtime rate? You will also need to know the employee's base hourly rate and to which earning the overtime should be attached. Non-cash benefits. Does the entity offer any non-cash benefits? If so, what, how much, and which employees are eligible for them? Leaves. What paid leaves is the employee eligible to receive? The employee's hourly rate, and to which earnings should the paid leaves be attached? Employee information. The Information tab contains the basic information to establish an employee in the system, like the employee's name, address, and contact information. Employee ID. The employee ID is created by the fiscal officer and identifies the employee. It should be something that makes it very easy to identify an employee. An employee numbering system does not work well because there are some screens in the software and reports that only show the employee ID and no name, which would make it hard to easily identify the employee unless you had memorized every employee's ID number. The simplest ID is just using the employee's last name. You may want to use all capital letters or only the first letter capitalized to keep names in a uniform list. Employee information address box. The employee's email may be entered here if the employee gives their email to the entity. The email can be used for two purposes. The fiscal officer may email the employee a copy of the employee's direct deposit paycheck. The entity should have the employee sign a consent form allowing them to use their email to send them a copy of their EFT warrants. As you can see in the address box, the fiscal officer can send a test email to the employee before emailing any EFT warrants. And the second purpose is for any other correspondence the entity may wish to email to employees. Employee information, other data. Status, full-time or part-time. The fiscal officer should pay close attention when adding new employees to be sure that each employee is designated properly as full-time or part-time. The designation here helps to complete the required quarterly wage detail report for the Ohio Department of Job and Family Services. Employees who are set to full-time will be defaulted in the report as having worked 13 weeks and all 3 months. Employees who are set as part-time will be defaulted in the report as having worked 0 weeks and none of the 3 months, and the fiscal officer then has to manually enter the number of weeks worked. So marking the full-time employees as full-time here helps save time later on. Birth date. This must be filled out to complete the Ohio New Hire Reporting Form. Employee information, state retirement data. OPERS member date. This date must be filled out if an employee will have OPERS contributions withheld from their wages. If the date is not filled out, you will not be able to add OPERS as a withholding for the employee. OP&FPF member date. This date must be filled out if an employee will have OP&FPF contributions withheld from their wages. If the date is not filled out, you will not be able to add OP&FPF as a withholding for the employee. OP&FPF hours base. This number, if entered, is defaulted into the OP&F contribution report. The contribution report reflects hours paid for any OP&FPF contributing employee on a monthly basis. For most months of the year, the base or worked hours will be 160, 2 biweekly periods at 80 hours each. There will be months, though, in a year that will have 3 pay periods. In that case, the base hours would be 240. Since most months' base hours will be 160 hours, it saves time to fill in 160 here to default into the report. The report base hours can be edited when a month has 240 base hours. Employee information, tax exemption data. Ohio IT4. Enter the number of exemptions the employee indicated on line 4 of their completed and signed IT4 form. federal W-4. Enter the number of exemptions the employee indicated on line 5 of their completed and signed W-4 form. W-4 rate, married rate or single rate. Enter the marital status as indicated by the employee on the completed and signed W-4 form. This information directs the employee's federal tax rate. Employee withholdings. As you can see in the top grid, UAN automatically adds the Ohio income tax and federal income tax withholdings for each employee. The tax tables are added for both and are updated by software updates each year or whenever there are changes to either tax table. We will look later in this level at how exemptions, marital status, and pre-tax deductions affect how taxes are calculated. It is here the fiscal officer adds all of the other withholdings for each employee. Employee withholding OPERS. There are two groups of OPERS members, OPERS government and OPERS law. The two groups must be reported to OPERS on separate monthly contribution reports and have different rates of withholding for the employee share and employer share. For example, in 2015, the OPERS government employee share was 10% and the employer share was 14%. The OPERS law employee share rate was 10.1% and the employer share rate was 17.4%. You can see that it is important to choose the correct OPERS group to ensure that the proper rate is withheld and that the reports submitted to OPERS are correct. If the entity has legislated policies and agreement with OPERS for a fringe benefit pickup or salary reduction pickup, the fiscal officer would enter it here in the appropriate box. If there are no legislated policies, then the employee share of OPERS is entered in the regular box. If you are not completely certain which OPERS group or employee share distribution to assign to the employee, find out before you proceed, because correcting wages and reports with incorrect retirement information requires significant time and effort. Employee withholding, OP&FPF. There are also two groups of OP&FPF members, OP&FPF Fire and OP&FPF Police. The two groups must be reported to OP&FPF on separate monthly contribution reports and have different rates of withholding for the employee share and the employer's share. For example, in 2015, the Fire employee share rate was 12.25% and the employer share rate was 24%. Police employee share rate was 12.25% and the employer share rate was 19.5%. You can see that it's important to choose the correct OP&FPF group to ensure that the proper rate is withheld and that the reports submitted to OP&FPF are correct. If the entity has legislated policies and an agreement with OP&FPF for fringe benefit or salary reduction, the fiscal officer would enter it here in the appropriate box. If there's no legislated policy, then the employee share of OP&FPF is entered in the regular box. If you are not completely certain which OP&F group or employee share distribution to assign, find out before you proceed, because correcting wages and reports with incorrect retirement information requires significant time and effort. Supplemental federal and state withholding. An employee may request on their completed and signed IT-4 form or W-4 form for federal that an additional amount be withheld from each pay. This is called a supplemental state or federal withholding. The employee may choose only one supplemental or both, but the fiscal officer must have signed IT-4 or W-4 forms to withhold any additional amount. Do not change an employee's supplemental withholding amount on an oral request by the employee because they could use some more money that pay. The employee must submit a new signed I-2 or W-4 before any amount can be changed. The fiscal officer can find the supplemental amount to enter as a withholding on line 5 on the I-4 form and on line 6 of the W-4 form. There is no employer share for supplemental state or federal. This is an employee-only withholding. Employee local income tax withholdings. This tax is paid by residents of a city or village that has imposed a municipal income tax, as well as non-residents who work in the municipality. Different income taxes must be set up as separate withholdings, since most will have different rates of withholding and payments are often made to different payees. In our sample withholding, you can see we have the City of Columbus local income tax. Notice that the payee is specific to Columbus. The income tax is paid to the Columbus City Treasurer. Further down, you can see that the Columbus City income tax is given a specific W-2 abbreviation, Columbus. You would want to give any local income tax their own specific name so that it's easier to see on the W-2 for each employee. The amount deducted from an employee for Columbus City income tax will appear on the employee's W-2 on a separate line with the abbreviation Columbus next to it. Employees can have more than one local income tax deducted. An employee may work in a city with an income tax and live in a village with an income tax. Employee local school district income tax withholdings. Different school income taxes must be set up as separate withholdings, since most will have different rates of withholding. In addition, each local school district income tax must be separated and accounted for on the employee's annual W-2. Here we have our sample withholding maintenance screen for Jefferson Local School District income tax. In the detail box, you can see that the Jefferson Local School District income tax is given a specific W-2 district number, 4901. The amount deducted from an employee for Jefferson income tax will appear on the employee's W-2 on a separate line with the district number next to it. So you would want to have each school income tax set up separately with their own district number so that each can be accounted for on any employee's W-2. Several school districts have enacted an alternative earned income only tax base. If a school district enacted this base, the fiscal officer must note it in the detail box under the district number to make sure that the school tax is calculated correctly. Most local school district income taxes are rate-based, but if a local school tax would happen to be an amount, the fiscal officer can put an amount in here. There is no employer share for local school district income tax. Employee miscellaneous withholding. Any other necessary deductions are added to employees as miscellaneous deductions. Examples of miscellaneous deductions are child support, wage garnishment, employee portion of medical insurance premium, non-cafeteria plan, union dues, and charitable deductions. As you can see, there's a place at the lower left of the screen in the miscellaneous box to enter a case number or an order number. These can be used to enter this information for child support or wage garnishment. The numbers are noted on the documents from the court. Employee earnings, classification, and unemployment eligibility. This section indicates whether wages will report on the quarterly Ohio Department of Job and Family Services report. A person who fills an elected position, such as a trustee, township fiscal officer, or clerk treasurer, should be marked elected so that the unemployment eligible box is not marked. Although some elected officials are appointed to fill an unexpired term, they should still be marked as elected for this classification. The choice appointed is meant for positions such as administrator or a non-elected village fiscal officer. These people are appointed and sworn into office, but their pay is unemployment eligible, unlike an elected official. If you are in doubt, always contact the Ohio Department of Job and Family Services to determine if an individual is eligible for unemployment before you set them up in the software. The final section of an Add Employee Earnings screen is the detail area at the bottom of the screen. Pay changes in this area is optional, but it's a great way to keep track of employee raises, the resolution number for the raise, and when the next pay review is, and possible raise date. OP&FPF is optional, but it must be completed if the employee is OP&FPF fire or police. The user must enter the correct pickup code and frequency. If you are not sure what belongs in this area, call OP&FPF for guidance. If this is not completed for each earning added for fire or police employees, the monthly OP&FPF contributions report will not generate. Leave of absence. This is optional, but helps to track the date of any unpaid leave of absence or workers' compensation leave of absence, begin date, and how many hours the leave was. In the Employee Add Wizard, once the user has added all of the required earnings for the employee, the user must attach the withholdings that will be applied with that earning. You can see this on the bottom of the screen. Selected withholdings will appear checked. Unchecked items will not be withheld from this earning. You would only exclude a withholding under particular circumstances. For example, if an employee has a per item payment or earning they receive separate from their regular paycheck, or if they receive the payout of unused vacation leave, then some withholdings don't need to be attached to the earning. If the health insurance is already withheld from the regular paycheck, it wouldn't make sense to withhold health insurance from unused vacation payout. Another example is a library employee that works at 2 library branches in 2 different local taxing districts. The earnings would be set up by location, and you would only choose the local tax that applies to that earnings location. Townships will use this if part of their property, such as a cemetery or firehouse, is inside the corporation limit of a city or a village that has an income tax, and part of the property is outside the corporation limit and is in the township where there is no income tax. When the employee works inside the corporation limits, they are paid for hours worked with an earning that has the income tax attached. If they also work at the location outside of the corporation limit, those hours would be entered on an earning that doesn't have the income tax attached. The exclusion of withholdings is particular to these odd occurrences. Employee leaves. 1 or more leave earnings can be added to an employee. Leaves need to be added to UAN according to the entity legislation and policies. An employee leave is a leave assigned to and customized for a particular employee. Now remember, UAN already has set up sick leave, vacation leave, personal leave, comp time. Your entity may have some additional other leaves. You can set up these leaves with customized names, such as bereavement leave. Hourly employee leave should be marked paid when used. This means the hourly employee receives paid leave that takes the place of the hours they would have worked. Salaried employees that have leave must be marked not paid when used. This setting means when a salaried employee is off work for sick or vacation leave, they can use their leave, but the salary remains the same. The software keeps track of the employee's leave balance. If you mark this incorrectly, A salaried person will be overpaid when you enter leave hours on the wage record. The most confusing part of adding a paid leave for an employee is in the details section of the Add Employee Leave screen. Let's take a closer look at it. Leave accrual and proration method. What? When paying wages, this setting determines the default number of hours this employee leave will accrue. The following methods are available. This leave is credited manually. No hours will accrue by default. The user must manually enter any leave hours earned when editing wages to be paid. The second choice is, this leave is earned per pay period. The number of hours entered will accrue for each pay period, no matter how many hours the employee actually worked. So this would be in your legislation. Say, your legislation says that for each time the worker is paid, they earn 3.1 hours of sick time. And the third choice is, this leave is earned per regular hours worked. The hours accrued will be calculated or prorated by dividing the number of earned hours entered here by the number of worked hours entered, then multiplied by the number of regular hours paid on the wage. For example, let's take vacation pay. For an employee that has 5 years of service, your legislation says they get 6.9 hours per 80 hours worked. That's how you would use this third option. And now, let's look at the bottom of the screen. Include in regular hours. When paying wages, this setting determines whether paid leave hours count towards the number of regular hours when calculating the accrual of prorated leave. Regular hours include all hours of hourly and salary earnings entered on a wage, and any hours of used employee leave. If an employee earns a prorated leave, but it cannot be accrued from using hours of paid leave, then the using this leave accrues all prorated leave checkbox should be unchecked for the paid leave so that it is not included in regular hours. If none of an employee's leaves are prorated, this setting has no effect. For example, if using this leave accrues all prorated leaves is checked, then in an 80-hour pay period, when an employee uses 16 hours of sick leave, all prorated leaves earn 100% of their set accrued hours, say 3.1 hours of accrued sick leave. If it is unchecked, then all prorated leaves earn 80% of their set accrued hours. Why 80%? Because 80 hours minus 16 hours of sick leave used is 64 hours, or 80%. Say their set accrued hours were 3.1, therefore the earned hours would be 2.48 and not 3.1 for this earning period. And that's the 3.1 hours times the 80%. Look in the center of our screen. Maximum leave balance. When limited balance 2 is selected, the balance for this employee leave cannot exceed the number of hours entered, whether from accrual, carryover, or adjustments to leave. This setting will apply even if a maximum annual accrual is set, but has not been reached. This should be dictated by entity legislation and policy. Maximum annual accrual. When limit annual accrual 2 is selected, the number of hours accrued for this employee leave within a single year cannot exceed the number of hours entered. This setting will apply even if a maximum leave balance is set but has not been reached. Any hours added through adjustment or by year-end leave balance carryover are not considered accrued, and they do not count towards the maximum annual accrual limit. This should also be dictated by entity legislation and policy. Current year. Current year is only available when adding a new leave for an employee. The user can add a beginning balance of hours for the leave if applicable. This depends on entity legislation and policy. For example, all employees are granted 16 hours of bereavement leave a year if needed under newly adopted legislation. So the user would then add a beginning balance of 16 hours here. How withholdings are calculated. Some of our clients ask, why is this tax not calculating as I thought it should have calculated? Or they may say, why is this tax calculating at 0? So we're going to talk about that a little bit. Most people think of withholdings as being either pre-tax or after-tax, but these are inaccurate terms. The effect that a withholding has on any other withholding or tax depends on the particular withholding in question. No withholding is considered pre-tax for every other tax or withholding. When calculating these three taxes, Medicare, Social Security, and local income tax, gross earnings exclude fringe benefit credits for OPERS and OP&FPF. When calculating these three taxes, Medicare, Social Security, and local income tax, gross earnings are reduced by cafeteria plan withholdings. When calculating these two taxes, federal and Ohio income tax, gross earnings excludes any non-tax earnings included in total earnings, fringe benefit credits for OPERS and OP&F. When calculating these two taxes, federal and Ohio income tax, gross earnings are reduced by salary reduction, Medicare, Social Security, OPERS, and OP&FPF, any cafeteria plans, and deferred compensation withholdings. When calculating school income tax, gross earnings are for the state income tax school districts identical to federal Ohio income tax as we just explained above. If it's an earned income only school district income tax, the gross earnings are identical to what we just explained, but it's not reduced by any personal exemptions from the W-4 or IT-4. When calculating deduction amounts for OPERS and OP&FPF and miscellaneous withholdings, gross earnings excludes non-retirement earnings, non-cash benefits, and fringe benefit credits for Medicare, Social Security, OPERS, and OP&FPF. So, how do W-4 and I-4 personal exemptions affect withholdings? How do W-4 and IT-4 personal exemptions affect withholdings? Federal tax personal exemptions that are on the W-4 form reduces federal income taxes. Ohio personal exemptions, IT-4 form, reduces Ohio income taxes and school income taxes, but for state income tax districts only. After personal exemptions, an employee may not earn enough to have any federal or Ohio income taxes withheld from their pay. How earning frequencies affect withholding calculations. Federal and Ohio taxes are progressive. Does that mean that they dress well? No. That means that as the taxable income goes up for each, so does the effective tax percentage. For example, an employee whose annual taxable income is $100,000 may pay $10,000 in federal tax, which is 10%, but the same employee with an annual income of $200,000 may pay $30,000 or 15% in federal tax. In other words, federal and Ohio income taxes are not simply calculated as fixed percentage of an employee's regular taxable income. UAN includes all relevant and up-to-date tax tables for accurately calculating progressive taxes. But this accuracy depends on setting appropriate pay frequencies for each employee earning, such as biweekly, monthly, quarterly. So let's look at our example again. If the $100,000 of taxable income were paid as a semi-annual earning rather than an annual earning, UAN may withhold $30,000 rather than only $10,000. This is because the daily taxable income for a semi-annual earning is twice the daily taxable income for an annual earning of the same amount, and therefore subject to higher withholding rates. I know the things we just talked about concerning taxes can be very confusing. Now, UAN has this great federal tax withholding worksheet. So we're going to look through this worksheet. The worksheet displayed demonstrates step-by-step withholding calculations for several withholding types. This worksheet that we're looking at is for federal, and you can see on the side federal worksheet, Ohio worksheet, school worksheet, local worksheet, and OPERS worksheet. So I have to give you a disclaimer here. This information is provided strictly as a convenience to UAN clients. UAN is not a taxing agency, and UAN support cannot provide tax advice or answers to common taxing questions. Consult your legal counsel, a tax attorney, or the applicable withholding or tax agency for any taxation questions not answered here. So let's look at this. So you can see here that different frequency types have different amount of days in them for the calculation of taxes. You can see weekly has 5 days and biweekly has 10 days, and so on. So to use this worksheet, you would take a specific employee and you'd look at their W-4 form, since we're doing federal, and you would stick in the number of exemptions here. Let's say they have 3 exemptions. Those 3 exemptions are then multiplied by the daily exemption rate. Now once we tab out after we've entered our federal exemptions from the W-4, it's going to multiply it by the federal daily exemption rate set up by the IRS in Publication 15 Circular E. It's multiplied and we get 46.20 for our federal daily exemption. Let's look at D, days for period type. This is from the table over here. So we have to figure what is our frequency, and we'll say our frequency is biweekly, so we're going to stick in 10 here. E is gross wage, including taxable, non-taxable, non-cash earnings, including any fringe pickup portions of Medicare, Social Security, OPERS, or OP&FPF. So for our biweekly person, we're going to enter an amount here. And this amount would be what they would normally earn to give you a good idea of what the federal tax amount's going to be. And F is non-taxable earnings. These are the UAN codes for those. We'll say our person doesn't have any non-taxable earnings. And G is wage reduction withholdings. That would be if they have OPERS or OP&F salary reduction and any fringe pickup portions of OPERS or OP&FPF. So let's say this employee does. They have an OPERS fringe pickup portion. So we'll enter that here, and that would be 10% of our employee's income. H is for cafeteria plan withholdings. We're going to say we don't have any of those. I is for deferred comp withholdings. We'll say our employee puts in $50 a pay for deferred comp. J shows us the net taxable wage before exemption, and that is E minus F minus G minus H minus I. And finally, we get to S, which shows us the total federal tax withholding for this wage. And if they're single, and if they've marked single on the W-4, that will be $65.81. Or if they marked married, that amount would be $31.41. So you can see how this would be a very useful worksheet for your employees. And this concludes Level 3 of Payroll 101. In this level, we discussed employer pickup plans, the Family Medical Leave Act, healthcare reimbursements, and the Affordable Care Act, unemployment compensation, withholdings in detail, such as OPERS and OP&FPF, Add Employee Wizard, how withholdings are actually calculated, and the UAN tax withholding worksheet. This concludes Level 3. Thank you.